We got markets steadying after some volatile days, including finding out that former Fed Governor Kevin Warsh, that hit the headlines in recent days, announced as the nominee to lead the U.S. Central Bank. But what are the longer-term investing implications of this news? TD Asset Management's Jeff Evans joins us now to discuss. We had been waiting for this announcement. We got someone, I think the markets are just trying to figure out what he means. I had one great conversation on Friday. It's like, which Kevin Warsh is going to show up? Is that the big question here, if he's the one to lead the Fed?
Exactly. And there's the interesting thing about Kevin Warsh is there's so many different nuances to his policy mix. There's different views on what he'll do on the short end of the curve, different views on the long end of the curve. And what's been really interesting in the last 4 weeks is we've had three different frontrunners for the Fed chair. Started with Kevin Hassett at the start of the month. I think was widely viewed as probably the most likely person. Very long-standing ties to the administration. Generally viewed as sympathetic with trying to help with affordability, get interest rates down, help stabilize employment markets. Then, of course, Trump threw a bit of a curveball, saying he'd like to keep him in his current role. Very quickly after that, you saw Rick Reader come in. And what both of those people had in common is if you look at prediction markets, so over the last couple of weeks, as different candidates have come and gone, you've seen the odds move around. On days where Hassett or Rick Reader were seeing their probabilities go up, the 10-year bond yield was coming down. So generally viewed as dovish, with in line with the consensus view that they would likely be likely to bring interest rates down, perhaps maybe a little bit more than warranted. If you look at all the other candidates, it was Warsh on days where his probabilities were going up, 10-year bond yields were also going up. So the market's very clearly viewing him as a candidate that was less likely to cut rates and maybe even put upward pressure on the 10-year. When you dig into the details, though, he's actually been pretty clear on the short end or the policy rate. He wants rates to come down. He views them as too high. And a key part of his strategy is what's happening with AI and productivity growth. And so part of the view is if AI and productivity growth are stronger than expected, you can probably get decent economic growth without necessarily the inflationary pressures that you'd otherwise have. And if that's the case, you can probably justify having a lower policy rate. One of the key things we're watching for as he steps into that position in May and June is, do you start to see him reorient some of the Fed research functions? There's been a lot of talk about trying to get rid of some of the Fed research staff that have been focused on quantitative easing and those policies over the last 10 years. And they may try to reorient that to say, what's the productivity impact and what happens to rates? So I think that'll be one important thing to focus on. At the same time, though, they've also been focused at the long end. He's been very clear he wants to take the Fed's balance sheet back to a pure Treasury bill composition, sell off the mortgage-backed securities that they own, get rid of the 5 and 10-year bonds, just simplify the portfolio. Of course, the interesting implication there is that would mean mortgage rates up and long-term bond yields up, which is the opposite of what the administration is trying to achieve. So I think the interesting thing will be as we start going through some of the Senate confirmation hearings and as he actually gets into office and we start seeing some more speeches and get a sense of what he's talking about, which gets more priority? Is it the short end or the long end? That's going to give us a little more insight into how they start moving and what the long-term implications are for markets. But I think the most interesting tell here is the reaction we saw from gold and silver on Friday. Clearly very dramatic moves. The market had been positioned for a much more dovish Fed chair, maybe even somebody that was willing to commit a policy mistake or policy error by cutting too much. I think what Warsh has done is taken the tail risk out. So the risk of inflation running dramatically above target, a huge move up in 10-year bond yields, hopefully has been taken off the table. What we just need to do is get a little more clarification of, is the priority the short term coming down, or is he going to anchor a lot more on this long-term reorientation of the Fed balance sheet?
You have expect a bit more of that picture to the confirmation process. We don't even wait for him to get in the chair, right? We're going to start hearing his thinking, or we'd assume he'll be asked his thinking.
Exactly, and that's usually part of the process as we go through. There'll probably be a few little fireworks in here as well. Obviously, the other hold-up is what's happening with Powell and some of the investigations there. So I think that'll be probably the short-term noise. Do we get through the uncertainty around Powell? That'll open up then the nomination process. But then as you move through that, that would be pretty standard, is to get a deeper sense of what he's focused on. And usually when you're going through these things, that's when you get a little bit of clarity of what do they like to talk about and what are they actually going to do when they get in the seat.
Right, so that's one big part of the picture, what's going to happen at the Fed this year. Also, tariffs. We've been dealing with this issue for well over a year now. What's the latest on that front?
Exactly, and I think the other major macro thing that we need to be thinking about is the tariff situation. The big piece here is the Supreme Court heard oral arguments back in November, and it was done on an expedited basis. Given how important this is viewed to be for the U.S. economy, both the administration and some of the other parties asked the Supreme Court to hear the case faster than they normally would. and hopefully, I guess in theory, come up with a decision faster than otherwise expected. Clearly, it's a big thing. $300 billion of tariffs is a huge tax on the U.S. consumer, major reshaping of global business and supply chain. And then there's also the question of, does the president actually even have the authority to do this? Under the U.S. Constitution, it's Congress that can pass taxes. It's only very limited situations where the president is allowed to regulate commerce. Does that mean a tariff? Does that mean a permanent tax, or does it have to be temporary? So given how significant this was, there was a view circulating in markets that we would get a very quick decision, probably by the end of last year was being talked about. And given how the oral arguments went in November, a lot of the questions from the justices were pushing back on the administration, challenging whether or not they actually had the authority, really trying to get a sense of what arguments they were resting on to say the president could do this. And so just how the discussion went made it sound like the tariffs were more likely to be overturned. You're still seeing that in prediction markets today. Roughly a 35% probability is kind of the current number of the tariffs being allowed. So 75%, or I guess 70% that they'd be overturned. But what's interesting is we also didn't see any decisions in January. The Supreme Court had a number of days where they could have produced a decision if they wanted to. And now, for the next 3 weeks, there's actually no scheduled appearances. So we're going into a bit of a blackout period. We're not likely to hear anything. And so it is a bit curious that they knew they were going to have most of February quiet, didn't actually put this decision out when it is viewed as being quite significant. And so if it starts to delay into March or possibly even April, you might see the market start to shift their view a little bit. Why didn't this decision come out? Maybe it's not as critical as they thought, or maybe they're trying to find a way of keeping the tariffs in place, or maybe turning them down but not having to do refunds. It just starts challenging the narrative that this is going to be a very fast decision against the administration. And the reason that's important is ultimately, if you look at what's happened with companies, people importing goods from abroad have not been paying higher import prices, so it's not the exporter eating the tariffs. It's also not the consumer. Inflation's been a lot lower than economists would have expected. And so it's basically the business in between that's absorbing this through margins. They've been willing to do that for now because maybe there's a refund check coming. The longer we go without that, the more uncertain that becomes and the more willing they are to potentially pass price increases through. And then that comes back to you now have a new Fed chair with an uncertain policy outlook. So I think if this runs too much further into March without a decision, investors should be a little bit concerned in the back of their mind that we could see an uptick in inflation. And again, with what's going on with the Fed, it just raises a little bit of extra risk in a period where I think a lot of people hope we were through the inflationary noise.